The views and opinions expressed in the following paid pre-recorded program are those of the host, callers, and guests and do not necessarily reflect the views or positions of the station, its management, or its owners.
You are listening to the best of Keep What's Yours with Jeff Zufall on KTRS.
Securities offered through Kestra Investment Services, LLC. Kestra IS, member FINRA SIPC. Investment advisory services offered through Kestra Advisory Services, LLC. Kestra AS, an affiliate of Kestra IS. Capital Advisory Group, Inc. is not affiliated with Kestra IS or Kestra AS. Neither Kestra IS nor Kestra AS provide legal or tax advice and are not certified public accounting firms.
You work hard for your money. For the next hour, you're going to learn how to keep what's yours. Capital Advisory Group presents Keep What's Yours. Here are Josh Gilbert and Jeff Zufall.
Hello and welcome to the show, Keep What's Yours with Jeff Zufall. I'm Josh Gilbert, sitting here with Jeff Zufall, Senior Tax Strategist and Wealth Advisor with Capital Advisory Group. And welcome to another week of Tax Talk with Jeff.
It's a beautiful week at that.
It really is. And I always say summer starts after Memorial Day.
Yes.
Now, I know that the calendar nerds will tell you, well technically, you know, they'll push their glasses up on their... Technically, summer doesn't start until, June, whatever. But no, if the pools are open, summer is here. If school's out,
that's right.
Summer is here.
Yep.
So...
happy summer.
Summer technically what, June 20-something to September 20-something?
Yeah.
Look, if school's in session and the pools are closed,
that's right.
It's
not summer. That's right.
It ain't summer. Memorial Day to Labor Day, that is summer to me. So we are in the thick of summer as we speak. And we'll talk about a couple of things today that are in the news and a couple of things that can maybe possibly pertain to you. But sometimes I like to talk math. Because what do you say, Jeff?
Math always wins.
Math always wins, and
yes.
you can't compete with it. And whenever we're talking about saving for retirement or doing our taxes or distributing in the distribution phase of our retirement, we have to use math to find out what is the most beneficial to us when it comes to taxes.
Mm-hmm.
And most of us, I'm going to go on a limb here and say, most of us don't know how to do math that well.
I'll say the vast majority don't. And I don't mean that offensive to anybody, but I don't think it's taught that much. We talk percentages all the time, and people look at us like, oh, yeah, 1% or 2%, that's not that much. And in reality, it turns out to be a huge chunk of change.
Mm-hmm.
So we, instead of talking in percentages and, calculations, we talk in real dollars. To be like, hey, that's going to cost you $15,000, even though it's only 1%. So,
and that's the thing. It's like, Jeff. If you go in to see Jeff, he can probably save you more than this, but he can save you 1% on your taxes. And you say, well, 1%. Why would I bother?
Exactly.
But if your boss offered you, just tomorrow, hey, we're going to start paying you 1% more. You wouldn't turn them down.
No, you'd say thank you.
You would say thank you and collect.
Or you'd say it's about time. No.
And if you make $50,000, what, 1% is $500?
Exactly.
You're going to turn that down?
Yeah.
No, you wouldn't. So, and over the course of your career, $500 a year, compound interest, that's another math equation.
Exactly.
What does that add up to? So you're leaving money on the table if you're not using Jeff for your taxes. You're leaving money on the table if you're not using Jeff when it comes to accumulating your wealth and getting ready for retirement.
Exactly.
And you're leaving money on the table if you're not consulting Jeff when it comes to collecting on your retirement. You spend all that time, 20, 30, 40 years of work putting money away for retirement. Why would you just fritter 20, 30% of that away in taxes when maybe you don't have to?
Exactly. So again, we look at it holistically, and we're looking at your financial plan and your tax plan, and it doesn't have to be a formal tax plan, but just yesterday had a conversation, and the game that we're playing is the way that their income is structured. They pay minimal tax on their Social Security, and they both make really good money on Social Security. They're top notch. So the concept on it is don't do anything else and we only have a small window of income that we could go take money from an IRA. And they're okay, but they weren't aware that at 6 years, 7 years, required minimum distributions will show up, and boom, their nice little setup that we have will be destroyed, and they'll end up paying tax on 85% of their Social Security, and they'll end up paying tax on everything that's pulled out of the IRA. And the comparison I showed them was stunning. I mean, just they owed $20-something thousand more in tax just with that small adjustment, and they weren't aware of it.
And that is a math equation that we probably, and again, 1 + 1 is 2. I could probably still do, if I wanted to, my multiplication tables.
Count on one finger.
from the third grade. But when you talk about compound interest, when you talk about when's the right time to start converting
Exactly.
To a Roth conversion.
When's the best time to take your Social Security? That's the question of the day.
These are math equations that we probably just aren't familiar with.
Yeah.
And even if I sat down and tried to figure it out, I'd probably do it wrong.
I'd say the vast majority would.
So having somebody in your corner that knows the math and knows how to do it, because math is unrelenting. Math doesn't care who you are. Math is one way, and if you're not doing the math right, you could be missing out on thousands of dollars.
Exactly.
And this show is called Keep What's Yours.
That's the whole point of it.
Not give more of what's yours to the federal government.
That's easy.
In the form of taxes. Now, we'll do math later on in the show, yay. But it really, I mean, it's your money.
Exactly.
This is math when it comes to your money. You should be, tuning in every week because a show of hands, who pays taxes here? Me. Even Jeff pays taxes.
Yes.
So if we're not doing it right, then we're giving more money to the government than we need to. Let's talk about what's in the news these days. I want to talk about private equity and Red Lobster, but we'll get to that in just a second.
Mad, aren't you?
I am kind of mad because those Cheddar Bay biscuits are so good.
They are very good.
And if private equity runs those out of business, we're going to be pretty miffed.
Yes.
Oh, back in my day, we had these Cheddar biscuits. And then some private equity group bankrupted the company. It's like, what happened to that restaurant? Private equity ran it out of business.
Yes.
So we'll talk about that in a second. But the Fed, they are meeting here in the fall. Is that their next meeting?
They meet in the summer, but the summer, basically, everybody's going to say they're just going to hold tight. They're not going to do anything. They really can't do anything yet. And what I'm getting at is in the fall of last year, the Fed said that they were going to decrease, or the possibility existed that they would decrease interest rates 3 to 4 times this year, 2024.
Has it happened?
No, and it can't right now. So again, and we've talked about this in the past, January, February, March, CPI, Consumer Price Index, ticked up just a touch. And you're talking 0.5%. And you go, oh, that's nothing. There's the math again. Mm-hmm. But it's huge to the big picture. So everybody's like, oh, so if CPI goes up, that means inflation is still in our economy. And then mysteriously in April, it was a negative number, which means inflation just disappeared. And it didn't disappear. It's the magic of math. So to the CPI calculation, our great elected officials took out raw coffee beans out of the equation, which were up 78% year over year. By taking raw coffee out of the equation, it calmed down the CPI numbers and makes it look like inflation doesn't exist. Problem is it's still there. You see it. When you go to the store, you go to buy something, inflation is rampant.
Oh, yeah.
So, again, when you look at inflation, you don't want to look at it as a speedometer going, hey, this is where we're at. We're at 55 miles an hour. You want to look at it as an odometer to say, hey, 4 years ago, coffee cost $2. Today it cost $8. There's an issue. So that's where we sit. So the Fed, really their hands will kind of be played over the summer from what the economists are saying not to raise rates or lower rates. There is a far, far, far remote possibility that they could raise interest rates a quarter. Again, if inflation keeps kicking up month after month over the summer, it's a long shot, but it is a possibility, so don't discount that. But the concept is they meet in the fall, and guess what's in November? what is it, November 4th?
Oh, the election.
Day.
Yeah.
So guess when the Fed meets? The week after the election. So for the election, or for the Fed to be neutral politically, not decrease rates or raise rates or, far or against the current administration, literally the Vegas odds are like 86% that they will decrease rates the week after the election.
After everything, all the votes have been cast.
All the votes are done, and we know who won.
Hopefully.
Hopefully. Not the, what was it, the Chad?
The hanging Chads.
Hanging Chad, yeah. Hopefully we don't have that. But
well, that's interesting because you've been saying for years that in election years, the Fed always kind of sits tight.
Neutral, just so they don't push it one way or the other.
Because if they raise rates, that's good for Trump.
Exactly.
If they lower rates, that's good for Biden.
Yeah.
So they don't want to be seen
as
playing politics.
Political. I mean, that
they're not kingmakers here.
You know that they're probably somebody from the White House is calling over there, going, "Hey, do whatever you can.
You should lower rates.
Yeah, make it look good." And every administration does that. That goes down, even though the Fed is a separate entity from the U.S. government. They report to no one, and a lot of people don't realize. They think that they're an arm of the U.S. government. They are, but they report to no one. So when it was actually created back in the day, you go, what were they thinking? But so you have, the top brass is probably reaching out to them, trying to persuade them to go one way or the other.
Of course.
But they technically, if their hands played.
Let's send them an edible arrangement
yes.
today.
A couple of them.
Yeah.
It costs millions of dollars. No. So that's where we sit today. So the Vegas odds are saying that the Fed will probably cut rates right after the election.
86% chance.
86% chance.
I like those odds.
So yeah.
And
that's from the Chicago Board of Exchange, where they play this little, hey, what are it's literally Vegas odds. You could probably bet on it in Vegas.
Now, last year they'll probably lower rates next year. They'll probably lower rates next year. Oh, they'll probably raise rates next year. But I was thinking in the back of my head, you've been saying this for 2 years. Jeff Zufall saying they never like to play politics in an election year. They probably won't raise rates. And everyone, well, they're probably going to raise them. It has stood to what you said. Yeah. They haven't touched it.
Yeah, and they should stay neutral unless they're data dependent, which means if they see something that nobody else, they got way more data you hope they got more way data than what we have. But they can, I don't want to say they can forecast the future, but they see a lot more data than we do. Mm-hmm. And it's in real time, and they know how to interpret it. So the Fed, you would hope, would make sure that they keep, because they're looking, everybody thinks the Fed looks, short term, like the next 3 months. They're looking 10 years down the road saying, hey, if we do this, what is the side effect 10 years down the road? And that's kind of the game that gets played on a regular basis.
Yeah.
And it's very boring and dry if you ever listen to it's not what the joke is, it's not what they do, it's what they say. After they do their little meetings, they'll get out and do a press conference, and they'll put a dissertation out there that's 50 pages long, and people will gobble that up and read every word that they say and try and guess at what their interpretation is going forward. So.
And you said, let's get back to CPI numbers. They dropped coffee. I understand they leave out gasoline.
Gas and oil and food.
Oil and food.
Out.
Yeah. So that when you want to get a gauge of what it looks like, I see why you would pull out an outlier like gasoline, oil. Those prices go up and down.
Too variable.
The summer months, we always expected them to go up for the travel season, and they went down.
They went down this
now
year.
we don't even know.
But the question is current administration tapping what's left of the strategic reserves to keep oil prices down artificially until we get to the election?
Sure.
And everybody does that. The question is how they were supposed to replace what they took a year ago. And then they said, nah, too expensive.
Yeah, I'm not buying gas at this point. But they take gasoline, oil prices out. I get that. Coffee's up 78% since 2019 or whatever.
Yeah.
Wow, that's a pretty weird outlier. But then they took food out. They took groceries out.
That's
what do
what
we
you-
buy every
exactly.
day?
It's what you're buying every day. You
Gas,
you can't
food,
function without it.
and coffee.
Yeah. Well, coffee now at my age, so.
Right. Well, and I just don't, if you really want a real picture of what I'm dealing with, what the listeners are dealing with, people on Main Street are dealing with, find me one person that says, I don't grocery shop.
Everybody does.
Okay.
Everybody like to
does.
see what they eat, but
Right.
there's probably some people that grow their own food and can,
My
can
sister-in-law
stuff.
had chickens,
chickens,
but she eats more than just eggs.
yeah.
So, everybody's got to go to the grocery store. So I do find it weird that they take out the
And again,
things that
they did
everybody-
that in the 80s to calm down or levelize the CPI numbers so it wasn't triple-digit numbers, then freak everybody out. They're kind of doing the same thing today by taking coffee out. And you go, it's only coffee. But again, it's one of the indexes or one of the components of the index that should be there.
When you say food, does that mean grocery store or does that mean the Big Mac that's up like 30% since the pandemic?
It's a basket of stuff that you would buy from the store.
Okay.
So it's
So
when
not
I
like
say
restaurant?
No, it's not restaurant because dining out, that's the one. It's skyrocketed through the roof, but yeah, it's still everybody's going out to dinner. And then everybody's complaining about it, going, "Hey, it cost 10 times what it did last week or last month or last year."
Well, I think I finally hit a wall. Did I tell you this? I go to the
No.
grocery store. I need Worcestershire sauce,
Mm-hmm.
and not because we were making some. I don't even know what we use it for meatballs, and that's the only thing I really think we ever use Lee and Parents for. But Carney calls me and he said, "I'm making crab cakes. I need some Worcestershire sauce." So I go and give him my bottle, and then while I'm at the grocery store, I go to buy a new one, and up on the shelf, both are 16-ounce bottles of Worcestershire sauce. One's Lee and Parents in that fancy bag, and the other is the store brand. And one was $5.95 and the other was $1.95.
Mm-hmm.
And I think I realized at that moment, I got to start shopping the store brands.
I try to avoid a grocery store at all cost. I will fake sick so I don't have to go grocery shopping.
Yeah, I kind of like it. I find it calming. You find some new fun chips that you've never had before.
Oh, no, because I go through there and buy everything that I can't eat.
Right.
And I'm like, hey, I want that. I want that.
But I think my new thing is I'm going to go and try to see if I can get away with the store brand versions of most everything and see how much I could save.
Whatever happened to coupon cutters? Remember they used to have the shows on
Yeah.
TLC and the people could go and buy, truckloads of stuff and get it for free.
Yeah.
But where do you even get a coupon anymore?
I don't know.
Do you make them?
I don't know. That's a good question. Are they online? Do I have to use the app?
Yeah. Yeah.
They always want you to use the
Use
app.
the app, yeah.
So, are they going to raise rates? 86% chance of a rate decrease.
After the election.
After
That's kind of what they're saying. So again,
election.
not that we're predicting the market by no means, but that's what the Chicago Board of Exchange is saying. They're I'll say relatively accurate. And again, that can change as the summer goes on. If inflation keeps getting more or higher and higher, and when I say higher, it's up 2% in a month or nothing crazy. It is a fraction. It's 0.2, 0.5, but it's positive, which means inflation's still out there.
Yep. All right. We're going to go to commercial break here, but I want you to call Jeff. 636-394-5524. That is Capital Advisory Group, CapitalAdvisoryGrp.com. If you like what you hear, if you know that you need some help when it comes to your taxes, if you know that you need some help when it comes to planning for retirement, if you know you need help when it comes to collecting in your retirement,
Yes.
and just say, hey, look, I saved all of this money in an IRA, and let me remind everybody, that money's not all yours.
Exactly.
If you did it pre-tax, because you have told the government, I'll pay the taxes later.
Mm-hmm.
Well, that $1 million account that you have set up,
Shows up sooner or later.
the government is waiting with their hand open and saying, "You ready to pay us now?" So all that money's not yours, but we don't want you to pay a dime more than you have to.
Legally obligated to.
And there's a way to do it, and there's a way to not do it, frankly. And so we want you to do it the right way, and Jeff has the equations that can help you figure out when, how, and why to start maybe converting some of that to Roth or take it out responsibly. So You need help in all facets of life because the IRS is there.
Yes.
In all facets of our life, good, bad, otherwise.
Unfortunately, they are.
So Jeff is able to be reached at 636-394-5524, and you can find him online at CapitalAdvisoryGrp.com. This is Keep What's Yours. We want you to keep more of your money. We don't want you to give it needlessly, senselessly away to the federal government in the form of taxes. So we're going to help you keep your money. Jeff's helping me keep mine. He can help you keep yours as well. We'll be back. What's private equity? We'll find out right after this.
You are listening to the best of Keep What's Yours with Jeff Zufall on KTRS.
Keep What's Yours continues with Josh Gilbert and Jeff Zufall.
Back on the show, back to Keep What's Yours with Jeff Zufall. He saves my money, or I should say he helps me keep my money. Every year, he can help you keep your money, too. He is the senior tax strategist and wealth advisor with Capital Advisory Group. I go to him. My parents go to him. Heidi goes to him now. Her parents go to him now. Her sister goes. So getting the word out there and just making sure that if you want to keep more of your money on your paycheck, in your bank account, every 2 weeks when you get paid, you should go see Jeff, and he can tell you, you should do this, you should do that, you should adjust your withholdings so you don't get a surprise tax bill at the end. And maybe if you do a FSA like we're doing for my son's school, you can keep $2,500.
Right.
I think
in your pocket.
In our pocket.
Cash.
I think that's what we're up to these days. And that's real money.
Yes.
That's not, hyperbole. That is not, a credit or whatever. Maybe it is a credit. I don't really know how it works.
No, that's cash. It's money that you did not have to pay the IRS.
It is real money. And we're using that and some of it to go to Disney this summer.
Woo-hoo.
So, we had to fix our AC unit.
Yeah, I had to do that too. That's no fun.
Right. But we're not using it for that.
Yeah.
We're using it for Disney. We'll find money for the AC unit somewhere else. Now,
Open a window. Yeah.
Yeah, exactly. Back in my day, we used to sweat, and we liked it. Private equity has come up again in the news, and the last time I saw private equity bankrupt a company, I think it was Sears.
Mm-hmm.
And from what I was read up about, Sears sat on a lot of good real estate.
Yes.
I mean, there was a property in Brooklyn where a Sears had been for,
eternity. Yeah.
70 years.
Yep.
And it was prime real. You ever go to Brooklyn?
No, I've never been Manhattan. Could see it, but never went there.
We went a couple months ago and driving in from LaGuardia, driving through Queens, it had a bigger skyline than St. Louis. Queens has taller buildings than St. Louis, which is amazing. Brooklyn is, mini Manhattan now.
Yeah.
So you can imagine the real estate values there.
Oh, yeah.
Well, one of the Sears stores was in a prime real estate spot. I have no idea what they were selling this land for, but what it seemed like was private equity bought Sears. Didn't really care about the tools.
They didn't
the lawnmowers.
Because you can find a Craftsman tool and Ace Hardware and, you name it, you could find it, Home Depot. So now it's just out there all over the place.
They didn't care about the legacy. They didn't care about Sears being Sears. They just cared about the land that the buildings sat on. And they sold off the land, and Sears, as we know it, is no more.
Exactly. So capitalism, can't say that word, at its greatest. So they saw an opportunity. They purchased Sears. With that came Kmart. They tried to keep Kmart's alive as best they could with the intention that Sears had more real estate. That's what they bought them for.
Mm-hmm.
So private equity basically is going to be your hedge funds, and they kind of go hand in hand. You can't go buy this off the street. When they say private equity, it's private equity. So a group of individuals will round up very high net worth individuals, and somebody may give $1 million. They could give $5 million. They could give $100 million to put into the fund. It kind of has a time frame to it to a degree, where maybe it's open for 2 years, 5 years, but they all have a theory, and their theory is we got to make you money. So the private equity will go out, They could buy companies. They could flip them. Look at what happened with TWA back in the day. That was a private equity.
I mean, I was just a wee child when that all went down.
They destroyed a perfect company, but they were able to, and Carl Icahn made hundreds of millions of dollars on that deal. Stripped everything out, sold all the gate leasing, if you want to call it that, and then left everybody out of a job. You don't really care. So unfortunately, that's the game that gets played in private equity.
And that really affected us here in St. Louis.
Huge. Look at the A terminal versus the B terminal. A terminal is just now coming back to life, where there's actually flights coming in and out of it, or a lot, I should say. B terminal was Southwest. That's it.
Mm-hmm.
And you can't get a direct flight out of St. Louis, other than locals, if you want to call it that. They're very hard to get. The funny part is to get to Chicago through American, United, whoever. It takes 6 hours to fly because you got to go to Baltimore and then cut across and then come back into Chicago. Southwest has one flight or two flights, 55 minutes. They leave at 7 o'clock in the morning, every morning.
And these are millionaires already.
These are millionaires and billionaires. So to be, you have
what like BlackRock? That?
BlackRock, Blackstone. They all classify. Each one of them will have its own structure and its concept on what it's going to go try to do in the open market.
Is this a hedge fund?
Technically, they fall in the same category.
Sure.
Hedge funds, basically. So a hedge fund actually says. So here's the funny part. Is remember we've talked about this. It's called carried interest. So if you own a hedge fund, or your income is derived from a hedge fund, basically they pay maximum of capital gains rate at 15 to 20% max. So you and I, as an individual, you got your day job, your money coming in, that's ordinary income, and then you buy and sell your stocks, that's capital gain or capital loss.
Sure.
You're either at a 15 or 20%, depending upon where your income threshold is. So, but if you make $100 million a year and you own a hedge fund, you don't pay ordinary income on that. It would be 40% plus. They pay 20% capital gains maximum.
Whoa!
So they have
look at that game.
They have their own tax law created for them. So that's how big their lobbying group is.
So their income doesn't come in the form of a salary or a paycheck that we would normally know it.
They take capital gains. So
they take their money, invest it, and then when they pull money out,
they only pay a capital gain.
It's a capital gain.
So if you made $100 million a year, you have to own the property or the business or the trade, in a sense, for 12 months to be long term. But it goes to a capital gain, so it's 20% max. So you make $100 million, you and I would give $50 million back in tax. They're going to give $20 million in tax.
And I could play this game too, I guess, but I don't have the money to start with.
You don't. You're not a high net worth individual.
I'm not a high net worth individual to start with.
Yes.
And I cannot live off my gains.
Exactly. So the trick is you would need the capital as it sits today. You may put in as an investor, you may put in $5 million, $10 million, $100 million.
I mean, I understand how that works.
Yeah.
Because it is just an investment like I could do today. But they're dealing on hundreds of millions of dollars.
So they may only have 50 people that they bring to the table, but everybody's worth $50 million. That's a lot of money in that fund, and that fund goes out and does what it needs to do. So again,
the rich are getting richer.
Again, if they have the ability to go buy Red Lobster, knowing that they could care less about Red Lobster, they could sell the recipes off as one unit, but they know exactly what I'll say the corporate owned real estate is worth. And somebody does a calculation, they just start selling it off. And they don't care.
That's where we're at today. Private equity kind of tanked Sears, and now it's the Willis Tower in Chicago instead of the Sears Tower. But the latest casualty, I should say, is Red Lobster. And from all the reports, just think about where your Red Lobster is. It's probably on the side of a highway. It's probably in a very lucrative part of town.
Exactly.
As far as commercial real estate goes.
Yes.
And
now they also have to own that real estate.
Sure.
If they lease, it's worthless to them.
But this private equity firm came in and bought them in the mid 2000s, and immediately sold off the land and started leasing back all of the stores. Well, I mean, if I sold my house and then started paying,
there's a hedge fund or a private equity that you could literally today sell your house to, and then rent it back from them.
Yeah. At a certain point, the reason I bought the house is because I wanted to save money.
Yes.
Not, have rent go to nowhere.
Exactly.
So all of a sudden, Red Lobster wakes up and they have $200 million a year that they're paying in rent that they didn't have because they used to own the land they sat on.
They can't afford it, and they're done.
And now they're done. We can't afford this. And you would think that any person worth their salt, when they go to buy a company, would know that in a couple of years, paying this much money in rent is not feasible.
Hypothetically, but they got their cash and they did their distributions, and
the idea
I don't want to
is
say they don't care, but they don't.
Did they plan to run Red Lobster out of business when they bought them?
You don't know their game plan, but that could have been their game plan. Same with Steak and Shake. I mean, same way that's gone down. There's multiple companies that they're looking at it from where that's what their job is. They just don't buy a stock and say, hey, pay me a dividend. They're going in, and it's from an investor standpoint, it's what'd you do for me last week.
Right.
I mean, they live and die by performance. So if they go stale, all those investors that put up $50 million or $100 million, they pull their money and run. And then they have to reform a whole nother scenario. And there's hedge funds and there's private equity that it didn't work. And literally, they just write them checks. They shut down one day and they write checks to everybody and say, oops, sorry, we're done.
Wow.
And it happens all the time. So, and again, the flip of that is you get into hedge fund private equity, there is a Supreme Court case that hasn't been tried yet, but it's out there. And the question is can a hedge fund private equity speculate in residential real estate? And that's the question of the day. And you go, well, on the cover, you go, why not? I mean, that's capitalism. That's their job is to go make money for their shareholders. But then the reverse of that, you sit and go, ooh, wait a minute. They could go into a neighborhood, technically buy every house because they got deep pockets, every house that's gone for sale in that neighborhood, artificially prop up the real estate prices, and then start unloading, same effect. And then everybody that's owned a house has to go through this bubble in a sense where their house skyrockets and then falls off. And that's the question of the day.
And that seems to be manipulating on a level that is really just messing with us.
In a roundabout way,
so that they can collect a big payday
and make money.
But they just ruined the market.
I wouldn't say ruined the market, but they, in a roundabout way, manipulated the market, and that's the question.
Yeah.
And if you had enough money personally, you could go buy up every house in, Maryland Heights.
Yeah, but would I?
That's the question of the day. Or you just move to your own island.
Well, here's the question: is private equity evil?
No, I wouldn't say they're evil. I mean, they serve a purpose. If you're if you've got a net worth of $200 million, that's where you put your money.
Yeah.
You make money.
Yeah.
So
can I invest? In me personally,
No.
Are they publicly traded
not
companies?
publicly traded. It's kind of like a little syndicate in a sense.
A little club.
It's a little club, but you also have to make the mark in a sense to be able to be considered a high net worth individual. It's like $5 million of net worth.
So they're not calling me.
No.
They
You
don't
have
want
to,
my $500
and
investment.
in that case, you need an accountant, CPA, somebody to say, hey, this person qualifies with assets. And there's a letter that's drafted that gets turned in to them to prove, hey, you are not high net worth.
And like you said, do they always win?
No. I mean, some of them don't. Some of them get closed down. I mean, literally, you'll hear every once in a while, you'll hear private equity will literally just say, oops, sorry, it's not working. Their theory, their process, whatever it is, it didn't work, market conditions, and they just cut checks back to everybody for whatever's left.
Okay, so it doesn't always work.
No. Some of them have blown up, people
Royally.
have lost tens of millions of dollars individually, because it didn't work. You still have that risk factor, no different than us.
Yeah. So if you see the headlines about Red Lobster and them going through what they're going through, I know the first wave, I think they only closed one location down here in town, but there'll probably be a second wave of more
there'll
closures.
be second and third wave just to get everything shut down.
But if we have to live a life without Cheddar Bay biscuits, Jeff, I'm telling you, then I would start thinking, hey, maybe this private equity thing needs to be regulated.
Wait.
Because they're ruining stuff for the rest of us just to gobble it up and make their money and get out. So it's just a really interesting kind of way that some of these things work. And when we hear private equity, I don't think we really know.
Yeah, most
it
people
really
are like,
is.
it's the big bad evil guys. I mean, in some cases they've done people wrong, but again, it's capitalism. That's welcome to America. That's what it's there for.
All right, well, welcome to Keep What's Yours with Jeff Zufall. We're going to go to break and then come back and talk about stretch IRAs and some new rules and some kind of like, I think the government said, well, we never really told you had to take RMDs.
Yeah, they went, there's no interpretation of that.
Yeah. So maybe some things have changed, and maybe you should be made aware of them. So 636-394-5524. That's Jeff's phone number, CapitalAdvisoryGrp.com. That's where you can find him online. Jeff can help you with your taxes. He can help you get set up for retirement. He can tell you when to start doing conversions. He can tell you when to take your Social Security. It's all about math, and we'll talk math here in the next segment. It is Keep What's Yours with Jeff Zufall on the Big 550 KTRS.
You are listening to the best of Keep What's Yours with Jeff Zufall on KTRS.
Keep What's Yours continues with Josh Gilbert and Jeff Zufall.
Back on the show, back to Keep What's Yours with Jeff Zufall, and as promised, as threatened, actually, we're going to talk math here because, as Jeff always says, math always wins. And when it comes to an IRA stretch, that was done away with the Secure Act?
Yes.
Or,
yeah. So in the past, if you non-spouse, spouse just takes it over like it's theirs, flips names, and goes on. But if you inherit an IRA from someone in the past,
from my dad or my mom,
you did, Uncle Joe, whoever, you inherited it, and then what you did was you put it in a beneficial or a stretch IRA, and you used it for your retirement. But when you did that, typically you were forced to take a required minimum distribution based upon your age or their age, and it would actually be paid out little bits over time. Not a big deal, because typically you can make more money in the markets, and when you got to retirement, you got this chunk of change.
And the IRA, to go back a step, this is the one where, let's just say it's Dad's. He socked it away pre-tax,
Yes.
making the deal with the federal government, I will pay taxes on this later.
Yes.
Well, he dies.
Yes.
Comes down to me.
Yes.
It's not like the taxes go away.
No, they're still there.
If Dad had, $1 million under his mattress, I can inherit that without having to pay taxes on it.
Exactly.
But when it comes to the IRA, the government says
Somebody's paying it.
Somebody still owes taxes on this. I don't care if it's Josh or his dad.
Yeah.
Somebody's owing taxes on this, and so I'm still on the hook to pay the government.
Yes.
At some point.
Exactly. So you'd use it for your retirement, and then it's the same, or was the same story. You get the retirement, and you say, hey, how much do I take out? Every nickel you take out, you pay tax on.
And when it comes to Dad's IRA, he had to start paying RMDs at 72.
Actually, in the past, it was 70 and a half.
70 and a half.
Now gone to, and that was where they gave us a little bit. So they said, hey, we're going to make RMDs go from age 70 and a half to age 72. But when we do that, we're giving you, they kept calling it 2 years. We call it a year and a half. So when they did that, what they did was they took the stretch IRA provision away. And what they said is, hey, if you're non-spouse and you inherit an IRA, you get 10 years in which to cash it out.
I could have, before this, stretched it out
for eternity. And then
for
you would
30 years.
You'd been, in the past, you'd have been able, if you passed away, you would have left it to whoever your beneficiaries are, and so on and so forth.
The government's sitting here saying, we want the taxes from this account.
Yes.
We can't wait
30 years,
3 generations to finally get it all.
So now when you inherit an IRA, so the good news is that RMDs started at 70 and a half, they're now 72. They're now actually 73.
Mm-hmm.
But you cannot do a stretch. I mean, you do a beneficial IRA, but the old theory of a stretch IRA where you drag that money out for the next 30 years doesn't exist anymore.
You got to liquidate that account
10 years.
Any way, shape, or form in 10 years.
Yes. So one of the, I'll say, oopsies that was out there was everybody assumed when you inherited this IRA that you had to do a required minimum distribution on it.
If Dad was 76 and the RMD had already kicked in,
Yes.
and I inherit this,
Yes.
is the RMD attached to it as well?
So that was everybody assumed.
That was the
'cause
assumption.
That was in the past. That's how it was always treated. The IRS now has given another reprieve for another year because there was really no interpretation of that. So if it is a true stretch IRA now or an inherited IRA, you have 10 years in which to take the money out. And the IRS last year said, no, you really don't have to do an RMD. And then they said this year they're going to push it out for another year and say you really don't have to do an RMD.
What about 2-3 years from now?
Well, they could come back and say, all right, RMDs apply. But remember, you got a 10-year window. So let's say you inherit $1 million IRA. It was Dad's IRA, you inherit it.
Mm-hmm.
You literally have $1 million sitting there that he made a deal with the IRS that he share in the proceeds. So if you go, hey, I'm going to take that $1 million and walk,
I'm going to take it all at once.
you're going to pay the highest possible tax in existence. You'll be 45% plus with, state of Missouri tax in there too. So you go, why would you do that? So the theory is tax plan, but you'd also, mathematically say, I got $1 million and I got 10 years in which to take this money out. I'm going to take $100,000 a year plus any earnings and work my way to it over 10 years, or maybe do 50,000 this year and take another 150 out next year. There is a math game that gets played with that.
And I'm still working, and maybe I make good money. And if I took $100,000 out every year for the next 10 years, maybe that bumps me into a 30 or a 35% tax bracket.
Yeah.
That's still better than 45%.
Exactly. And that's the name of the game, is how do you work that out over time? If you get 50 grand, that's one thing. Maybe split it in two, depending upon where your income is today. Maybe split it in 2 years. You take 25 and 25, call it a day. Some people could absorb the full 50 and not have a huge tax burden.
You don't want to take so much out that you bump up your tax bracket.
Exactly. That's the game.
That's the game.
And it may be, even if it's 50, it's IRA money. So remember, it's tax deferred. You don't pay anything each year. It's just whatever you take out.
And when you start talking, you said percentages are what they are. Even 1%, 5%, 10%, you think, oh, that's little. On $1 million, you pay 45% plus. Let's just call it, you give the government half
of it back. Yeah.
Five. So I walk with $500,000.
Yeah.
If I paid 35% taxes, I'm walking with $650,000.
Exactly.
That's
the game you play.
Difference of $150,000. I
Yeah.
think I would try to go the
game.
route
Yeah.
of getting to keep $150,000 more.
Exactly.
So
that's the I say there was really no true guidance or interpretation from the IRS. So everybody just assumed, hey, if you inherited, you got this IRA money, you got to take an RMD each year going forward. Reality of it is now they know that they're going to get their tax money in 10 years, so they're bypassing the annual RMD each year.
If I inherited $1 million from my father in a stretch IRA that needs to be liquidated over 10 years, should I quit my job?
Technically, you could.
For the next 10 years.
Depends on if you're 55. You technically probably could, and then that would be your income for the next 10 years.
But then what am I going to do?
And at 65, you retire. You still have to save some of that, but that's $100 grand coming in the door.
Right. So, what's the $100,000? What's the tax burden on that?
Probably 20-ish.
20-ish.
Yeah.
Let's just say 24%.
Yeah.
You're still saving
a ton
of money.
Yep.
Just by taking it out $100 grand a year.
And here's the math calculation: time value of money, which means you're only taking out a small percentage each year. That money's still growing over time.
So the first year, $900,000 will grow. In the second year, $800,000 will continue to grow. So there's a way to properly, smartly, wisely take this money out.
Yeah.
And if we don't know how to do these math equations,
it gets really ugly really quick.
We're
It's
gonna
really
end up-
expensive.
right, we're going to end up giving more money to the government in
Yes.
taxes that we otherwise wouldn't have to.
Yeah, exactly.
So that is the whole point of hiring Jeff Zufall to act as your calculator for you. Because number one, he knows the equations. Number two, he can do the math for you. Number three, he can show you what everything looks like. And number four, it's not like he hasn't seen this before.
Yeah.
I always tell my wife, she always freaks out about every little thing. And I'm like, honey, it's not like we're the only person that has ever
Exactly.
been in this position before. So Jeff has seen just about everything under the sun. So when you bring him your case, we brought you mine with my mom and I and our condo. We had this weird, goofy thing going on. And Jeff's like, well, it's goofy, but it's not like I haven't seen it before. So Jeff can help you out. And just knowing that the math is out there and math always wins. And if you do it right, you can collect. And if you do it wrong, the government gets to keep more of your money.
Yes.
So it's just the game. And there's rules. And Jeff can help you walk through the rule book. And the rule book being the tax code.
Tax code. Very boring to read.
Yeah. Give Jeff a call, 636-394-5524. If you have personally inherited some money recently and you are wondering, how should I?
Yeah. What do I do?
Yeah. What do I do? How should I collect on this? Give Jeff a call, 636-394-5524. If you're in the accumulation phase, if you're about 55, 60, and you want to get ready for the distribution phase.
Yes.
Give Jeff a call and say, should I start doing conversions now? How do I do this smartly? Give Jeff a call. And it is always something where it's not like April 14th or 15th or 16th is when you call Jeff. It's a years-long conversation.
Every day.
Every single day. So give Jeff a call, 636-394-5524, CapitalAdvisoryGrp.com, Senior Tax Strategist and Wealth Advisor with Capital Advisory Group. Jeff, thank you so much.
Thank you.
And we'll see you next week.
You bet.
You've been listening to Keep What's Yours with Josh Gilbert and Jeff Zufall, Senior Tax Strategist and Wealth Manager at Capital Advisory Group. To learn more, call 636-394-5524 or visit CapitalAdvisoryGrp.com. The views and opinions expressed in the preceding paid pre-recorded program are those of the host, callers, and guests and do not necessarily reflect the views or positions of this station, its management, or owners.